Good evening, everyone. It is once again Ted the Speed Learner. Now let's see how well you recall things. Several years ago, I tried to discuss something from the Financial Accounting Standards Board. They had put out a whole bunch of statements. They've been putting out for years now. And one of the statements they put out was called Statement Number 3. And if you have a copy of this, you can find the first 150 of these statements, and the rest of them you can pretty much look up on the internet. So, anyway, let's get going, shall we? It has indeed been a long time since I've covered this topic, so I will start from the beginning. But before I do, I wanted to let you guys know that I published 5 Kindle books. If you are interested in any of these, feel free to leave me a comment down here in the comments below, and I will send you a link to my latest Kindle book. You can read it, and you can read the rest of them at your leisure. Okay? So let's continue. If you look at the title of the statement carefully, you will discover 2 very important pieces of information. This FASB statement is discussing accounting changes. The accounting changes they are referring to involve inventory changes. For example, if you want to change your inventory method from FIFO to LIFO. Okay? Now, FIFO is an acronym for first in, first out. LIFO is an acronym for last in, first out. And I covered both of these topics years ago on YouTube videos. I might cover them again. I don't know. We'll see. But take a look at the second piece of information that this statement presents. This involves interim financial statements. If you have never prepared an interim financial statement, you will struggle reading this text. When I first researched this topic, there were very few websites that discussed the topic of interim financial statements. Of course, that has since changed. This statement begins with an inquiry into using the last in, first out. Apparently, there is a way to use LIFO as a method to price inventory. But what if you're using FIFO as a method to price inventory and decided in the middle of the year to change it from FIFO to LIFO? How as an accountant would you report such changes on your interim financial statements? Alright, I'm going to give you a web article right down here in the description below, so take a look at it. So what is LIFO? As I stated before, LIFO is an acronym for last in, first out. As I stated earlier in this video, LIFO is a method used to account for merchandise inventory on an accounting income statement. Let's say you own a guitar shop. You receive a shipment of guitars. A week later, you receive another shipment of guitars. So you decide to sell the guitars out of the second shipment before you sell the guitars from the first one. Why would you want to sell guitars from the second shipment instead of the first? Well, let's suppose that the wholesale price for the second shipment of guitars was actually higher than the guitars in the first shipment. Since you have sold the second shipment of guitars, then all you have to account for is the wholesale cost of the first shipment of guitars. We already know that the wholesale cost of the first shipment of guitars is less than the wholesale cost of the second shipment of guitars. When you calculate your income statement, your income will look better than if you had used the first in, first out method. If you want to learn more about LIFO, feel free to read the web article I just shared with you. Now that you know a little bit about LIFO, I will tell you more about this FASB statement. The next thing this statement does is refer you to the Accounting Principles Board. Alright, before FASB existed, the APB, which is the Accounting Principles Board, released statements to help accountants perform their job duties. In this FASB statement, the authors refer you to APB Opinion 28. What is the topic of APB Opinion 28? This topic covers accounting for interim financial accounting. Ooh. We might pay attention to that. So let's look at APB number 28. We will pay attention to paragraph 14 of the statement. In this paragraph we find a discussion about cost of inventory. This paragraph will guide us on how to calculate the cost of inventory. Apparently there are several accounting methods accountants use to determine the cost of inventory. You could determine the cost of your inventory by either using the standard or actual cost method. These are methods I may or may not have covered in the past. If I have not, I will go ahead and cover them in a future video. If you use a standard method, you can estimate how much the inventory will cost you. If you're using the actual cost method, you account for the actual cost of your inventory. Now, for an example, factories may use either the standard method or the actual cost method because they are assembling parts to create their inventory. Retail stores often, on the other hand, use the FIFO or LIFO accounting methods because they don't assemble their merchandise usually before they sell it. It saves on labor cost. APB Statement 28 recommends that companies who use the LIFO method on their annual income statement also use the LIFO method on their interim financial statements. But this statement allows for exceptions to this rule. What are these exceptions? Some companies use an estimated gross profit rate when they are calculating their cost of goods sold during an interim financial period. This could be handy if they feel they are going to sell their product during a particular time of the year. For instance, let's suppose you owned a clothing store and you knew that your inventory of sweaters were going to sell very quickly during the fall time of the year. That's because you're anticipating an upcoming very cold winter. So you would estimate your gross profit based on the time of the year and the cold season you anticipate is going to finally come. Of course, this clothing store could use another method to calculate their cost of goods sold. But according to this statement, if a retail store uses an inventory method of accounting that is different from the one they plan to use at the end of the year, they have to disclose this change in inventory and they have to disclose any significant adjustments that result when they try to reconcile their cost of goods sold on their interim income statements with the cost of goods sold on their annual income statements. That's a lot of mouthful. The next thing this statement wants you to consider is what would happen if you decide to use the LIFO method on an interim financial statement and you have to liquidate your inventory. Let's say winter ended and you don't have a lot of you have a lot of sweaters still left in your inventory. They didn't sell very well. That's because the weather didn't cooperate. Let's say you had a very warm winter and a lot of people didn't need those sweaters. This statement directly mentions the liquidation of your base period inventory. I tried to look up the topic of base period inventory. I couldn't find anything on the topic. The APB Opinion 28 statement also says that at the end of the year, the inventory loss due to liquidation of your base period inventory would be replaced. I'm unclear as to how to account for this, so I'm no expert. If there is inventory loss due to the liquidation of your base period inventory according to them, that would be APB Opinion 28, the inventory at the interim reporting date should not give effect to the LIFO liquidation. So how does this inventory at the interim reporting date give effect to the LIFO liquidation? They don't state this very clearly. Furthermore, APB Opinion 28 states that the cost of sales for the interim reporting period should include something important. But before I tell you what it should include, I should clarify the statement of cost of sales. What is cost of sales? The cost of sales would include the building containing the inventory, the air conditioning or the heating used to keep the inventory from melting or freezing, Keep in mind that if you receive a shipment of chocolate, that you don't want this particular shipment to melt inside your store. You don't want that. And if you receive a shipment of bicycle parts, you don't want them to become brittle due to freezing. Getting this so far? Another thing to keep in mind when calculating cost of sales would be security and employees handling your inventory. And let's not forget electricity for all the lighting in your store. So what should this cost of sales include besides what I've just stated? Once you sell your merchandise, you will have to purchase more inventory so that you can then replace the merchandise you just sold. Therefore, the expected cost of replacement of the liquidated LIFO base should be included in your cost of sales for the interim period. The next thing APB Opinion 28 mentions is inventory losses. What is causing the inventory losses? According to the statement, the inventory losses are being caused by market declines. This may refer to raw food products like vegetables or whole grains. Or it could refer to energy companies purchasing petroleum products. After all, perishable goods like crops can increase or decrease in the market price due to the law of supply and demand. Woo! If you are suffering inventory losses due to market declines, APB Opinion 28 states that these losses shouldn't be deferred beyond the interim period where the losses occurred. What does it mean to defer a loss? What APB Opinion 28 is saying is that you shouldn't record your inventory losses on the next interim financial statement. You should record it on this interim financial statement because you incurred the loss during this period of time. According to APB Opinion 28, you can recover inventory losses due to market declines. Perhaps the value of the corn you purchased in bulk increases in value because the supply of corn decreases all over the world at some point in the future. This statement does say that these recoveries can occur on future interim financial statements during the course of the year. And I wanted to pause for just a second and say that I'm going to take these notes and I'm going to put them on my Facebook fan page so you can see them, because I know I'm saying a lot of stuff here and you may not catch all of it. The recoveries on inventory losses should be recorded as gains on future interim income statements. These gains shouldn't exceed the losses you recorded on this interim income statement. Businesses should be aware that market declines can occur during an interim period of time, and companies should be aware that these market declines are usually corrected in future interim periods. If a company is reasonably sure that these market declines will be corrected in future interim periods, then the company shouldn't include the inventory losses of the current period in their current interim financial statement. Wow, that's a mouthful. But we need to return to FASB statement number 3. After FASB statement number 3 refers us to APB Opinion 28, it then refers us to reporting a cumulative effect type accounting change. What is a cumulative effect type accounting change? Well, FASB immediately sends us to APB Opinion 20, as if you need to see that. If you read APB Opinion 20, you will find information about a cumulative effect type accounting change. I specifically refer you to paragraph 20 of APB Opinion 20. So you go to APB Opinion 20 and you look at its 20th paragraph, and that's where we're going to go. So what will you find if you read paragraph 20 of APB Opinion 20? Well, the first thing this paragraph refers you to is the interim financial statement. It mentions the cumulative effect on changing to a new accounting principle. What is this cumulative effect? Well, at this point, I really don't know. And I hope somebody can answer that. The paragraph states that the cumulative effect is the difference between two things. What are these two things? The first amount is the amount of retained earnings at the beginning of the period of change. Okay. The second thing this paragraph mentions is the amount of retained earnings that would have been reported at that date if the new accounting principle had been applied retroactively. And this leads us to the first question. What is retained earnings? Let's take a look at this web article. We've got web articles down here below in the description. Retained earnings are cumulative according to the web article. They are the net profits of a company, but these net profits are what's left behind after a company pays out dividends to stockholders. These profits would most likely be used to improve company buildings or to increase salaries for employees or for something else. And finally, we can continue with our discussion. I stated earlier in this video that retained earnings would have been reported at that date if the new accounting principle had been applied retroactively. How far back do we have to go according to paragraph 20 of FASB 27? Well, we're going to answer that question. Alright, so we're going to go back to paragraph 20 of APB opinion number 20, and this paragraph specifically states that we would have to go back to prior periods which would have already been affected. Which periods is this paragraph referring to? It's not very specific. The paragraph also states the following: by recognizing only the direct effects of the change and related income tax effects. What are the direct effects of the change? And what are the related income tax effects? Once again, this paragraph leaves more out than they actually put in. So how should this cumulative effect be stated in the interim income statement? According to this paragraph, this cumulative effect should be placed between the captions extraordinary items and net income. Okay. Whew. This paragraph also states that the cumulative effect isn't an extraordinary item, but should be reported in a manner similar to an extraordinary item. The final thing this paragraph mentions is per share information. This per share information is placed on the face of the interim income statement. It should include the per share amount of the cumulative effect of the accounting change. At this point, you should be asking yourself what this per share amount is and how to properly report on your interim income statement. I hope somebody watching this video can answer these questions. What else does FASB statement number 3 state? Well, I'm going to leave that for a future video. So I hope at that point you will stay tuned.